We hear economic numbers that are bad, right? We hear job numbers are bad. Inflation data, not great. Why is the stock market continually just hitting record highs? I want to talk about that. I want to learn more. Let's dive into it.
If you pay any attention to financial news, you've probably heard the same line every time the stock market has a little whoopsie-daisy.
$58 billion wiped off the exchange today.
$136 billion was wiped off.
$5 trillion in value had been wiped from the markets in just 3 weeks.
Yeah, that's right. Every time green line does not go up, we are told some company or the market has lost.
Well, that's good TV, right? That's how you keep the viewers glued to the news, glued to CNBC. Red equals, ah! You know, when I see red, I see green. Isn't that creative? Isn't that so creative, guys? When I see red, I see green. It just means I'm fucking buying, dude. I love red because it means I just buy in. I'm seeing a shit ton of green these days. I actually don't like it. I'm a little annoyed. I would love a good, I don't want a fucking, full on recession and correction of 20%, 30%, 40% dip, because that's jobs, that's lives, that's food on the table, that's houses. I don't like that. But I'd like to see a little 10%, just like take the profits, let it go down like 10%. Let me buy in. That's what I like.
Destroyed or wiped out however many billions of dollars. But all right then, where does that money actually go? It might not surprise you to learn that headlines like this are written more for shock and awe than genuine insight. But the simple truth is that the money doesn't actually go anywhere, because it never existed in the first place. Sort of. If you can look beyond the flashy headlines like this and actually understand what they are trying to say, you are going to be much better equipped to make sensible financial decisions when everybody else is busy losing their minds and, if they are lucky enough, maybe even their retirement savings too.
Yeah, I mean, if you're seeing red, why are you selling? Red is buying opportunity. Green is selling opportunity. Like, this makes no sense to me. Why are we getting out when we're lower? It's all fear. It's all fucking fear. That's all it is. And people fuck themselves.
This basic understanding has probably actually never been more important than it is right now, because the stock market is breaking new records every single week. Nobody knows if or when the party will stop. But what we do know is that
has to at some point, right? We got to take some kind of windfall. What is it? We see a correction, which is what, 20% down every 5 or 6 years on average, which means we'd be coming up to one in the next 2 years or so on average, right? I think that's where we are.
In this particular case, the money doesn't actually have anywhere else to go.
$5 trillion in value had been wiped from the markets in just 3 weeks.
Gold prices hit a record high on Tuesday.
Gold's doing well.
The dream of owning the house with the white...
It's a good diversification play. I definitely don't put a majority in there, but...
picket fence increasingly giving way to white picket renters.
You could buy a house tomorrow if the price was right, if the interest rates were where they needed to be.
Help for the economy from Washington remains nowhere in sight.
So there are really 3 different levels of technical explanation.
Yeah, hold always. I mean, especially if you're in your 20s, 30s, 40s, why the fuck are you selling now? That doesn't make sense. You have so long to go. Listen, if I was like approaching 60 and I was seeing a massive dip, if I was seeing like 2008, I'd be worrying a little, okay? I'd be worrying. But we're just, I know the demographics of the audience. Y'all aren't that, so.
Explanation for what happens to money during a crash. The good enough for most people level, the armchair market analyst level, and then the level that considers debt, consumption, and all the different asset markets that are getting kind of weird at the moment. Now, most people don't even get level 1 right, but I promise none of this is as complicated as the financial bros would like you to think. And actually seeing how these markets work is the only way to understand how messed up they really are at the moment. But alright, most of the time when headlines are talking about billions of dollars being destroyed or whatever, what they are really saying is that the market capitalization of a company or group of companies has been repriced. This is just calculated using the number of outstanding shares.
Tesla had a huge jump today after Elon invested $1 billion or bought $1 billion in shares.
Multiplied by the price the last share was traded at. So for example, Nvidia currently has about 24 billion outstanding shares, and right now those shares are trading at a price of about $170, which gives the company a market cap of $4.1 trillion.
Crazy,
If for some reason tomorrow people decided to start trading Nvidia shares at $85, then it would have the market cap of the company, and you would inevitably see headlines about Nvidia
well, that would be fucking insane in one day.
Losing $2 trillion. But they didn't really lose $2 trillion. They were just revalued using this very crude calculation. Now, technically, this could actually help Nvidia's ongoing business operations. Since the AI boom, the company has been doing a lot of share buybacks, where they will use their profits to buy company stock off existing shareholders to take it out of circulation. They are only supposed to do this when management thinks the company is undervalued. So if their stock halves in price,
Yeah, but Apple's been doing that since forever, and it just helps support that elevation.
they will get twice as many shares for the same money, which should be a good thing, right? Well,
Jensen is such a snake. What do we have against Jensen? I've read a book, The NVIDIA Way. It's basically a biography. It's kind of a story of the business as a whole. It's a great story. What do we not like about Jensen? I'm probably missing something.
this is assuming, of course, that they aren't just doing stock buybacks to drive up an already hyped up stock. Part of what is making the current stock market so strange at the moment is that by far the biggest net purchaser of shares in these companies are these companies. According to the Fed's Z1 financial accounts, households made net purchases of about $100 billion of stock in 2024. This was dwarfed by listed corporations that did over $625 billion worth of net buying, meaning that companies were buying 6 times more of their own stock than actual stockholders were.
Well, it just keeps it elevated, right?
Now, that doesn't seem great, but it's actually worse than it sounds. The whole point of a stock market is that it's supposed to be a place where companies
Oh, so is the suggestion because of the stock buybacks why the market is staying at all-time highs, even though we're not seeing great economic data right now? I can see that.
can go and sell their shares to raise money to fund business operations. This net sales figure also includes the company subtracting from this net number by conducting IPOs. The total gross value of stock buybacks was over $1 trillion within 2024 alone. It just so happens that companies also raised about $375 billion in the same year. Now, this has helped to increase market capitalization by driving up share prices, but that's not even the biggest problem. It will actually get more important later on as we go into how asset markets are supposed to function. But for now, for level 1, a market crash is just a readjustment in market capitalization. Unless a company is planning to sell its own stock to raise money to fund future projects, its day-to-day market
Which it definitely doesn't need to, at least NVIDIA.
capitalization shouldn't impact its performance.
Oh, we got someone fighting at Sean Brooks. You're a moron. What did Sean Brooks say? Jensen makes speakers for guitar amps. Okay. I don't think that's...
Market capitalization is
Oh, here we go. The answer to why is a snake. The GPUs have been false advertised based on what they've been selling as of late. The contents within and the performance. Gamers Nexus has been doing great exposes on it. Interesting. Well, I mean, for what it's worth, NVIDIA is mostly... their GPUs are mostly... No, it's not the like 30, 40, 50, 60s and shit like that that's actually making the business money. It's about the... Fuck, what are the data centers for AI.
kind of like GDP. It's a number that we use a lot because it's sort of easy to calculate, and
They got sued. What happened?
it's good enough as a rough indication of if things are going in the right direction or not. Now, a lot of people, when they learn this, take it to mean that market cap is irrelevant. A $10 banana is no better than a banana that's on clearance for $5. And while that's true, a sudden price drop on anything can be an indication that there is something rotting away beneath the surface. So, for the next level of understanding, you need to do what the journalists writing the headlines aren't willing to do, and actually follow the money. Now, I know I just said that if a stock halves in value, that doesn't necessarily mean that any money has gone anywhere. But in highly liquid markets, such
Well, kind of. I mean, it's taking money out, right? Like if someone's selling, they at least got cold hard cash.
a scenario can only really happen one way. The NASDAQ doesn't get to slap a 50% off clearance label on Nvidia stock like Walmart does on questionable milk. The way the price moves in these kinds of markets is that if there are more sellers than buyers, the price falls, and if there are more buyers than sellers, the price rises. When people are panic selling stocks, they are still getting money in exchange for their stocks. It may not be as much as they wanted, but what they then do with that money is where things get interesting. Let's say you had some spare money. Yeah, I know, but just pretend with me for a second. With your pile
I got money. I save. Fucking had quarterly estimated taxes fucking came out. That sucked. That fucking dicked me. Business is getting complicated now with the earnings and expenses. Ugh. Hi, listen here, Financial Audit. I've curated the exact resources and tools I personally use or would use if I was in certain situations. So take advantage of these offers in the resources section in the description below. The first one, I've moved my investments to Webull. Do the same and transfer to my investing app of choice, and you get cash bonuses of $200 all the way up to $30,000 depending on initial funding amount, and up to 8.1% APY on your money, and up to 3.5 matches for your IRA. And then number 2, a great new checking account that I've switched over from SoFi, and it's called Chime. Get that $550 bonus when you sign up with direct deposit and get almost 4% on your money just sitting there. And then 3, automate your investing with Acorns. Usually sign-up incentives are only $5, but you get $20 with my link. Number 4, you can increase your income and boost your resume with a course career certification. 5, if T-Mobile is good in your area, switch to Helium and get a literal $0 a month phone plan for the same exact service. But most importantly, go get your free Hammer financial score and see where you stand in the world of finances. Take the assessment at calebhammer.com. You will not regret any of these. Change your life today.
Of cash, you have some options. You can invest into the stock market, real estate, bonds, gold, alternatives like cryptocurrency, or you could just hold on to your cash. Alternatively, if you just want to enjoy your life right now, you could spend that money on goods and services like a new car, a bigger house to live in, or a nice vacation. All of these activities that improve your quality of life are generally classified as consumption. Depending on where you and everybody else who has spare money puts their cash, it will increase the value of these markets. So if everybody buys gold, its price will increase as demand increases on an asset with limited supply. Now, stocks, bonds, and real estate are kind of unique because they generate their own cash flow to give money back to you. Stocks do this through dividends, bonds through interest, and real estate through rent. Those cash flows come from other people deciding to put their money into the consumption pile, which becomes revenue for these 3 asset classes. But all of these other assets really only make returns by having more people buy in at a progressively higher price.
Going into stacks of money, that's right.
When the stock market crashes, what is really happening is everybody trying to grab their cash out of that particular asset market. They do this either because they think the market won't generate as much cash flow in the future, or more often, just to get their cash out before everybody else lowers their price by taking their cash out.
I just don't understand selling. Unless it's an individual stock that you just don't agree with or don't have confidence in. If you're just buying the overall market, it just makes no sense.
Now, if you were lucky enough to get your cash back before everybody else, you have a choice. During a lot of market crashes, people just want to hold on to their cash because they are afraid they will lose their jobs and nothing else is generating cash flow.
That's true.
But eventually, you will need to put your money somewhere. And that predicament is what is creating such a big problem right now. Sure, maybe you think that the stock market might be an AI-fueled bubble. But if you sell your positions, where exactly should you put your money? Gold is at all-time highs. Real estate is risky with today's interest rates. Cryptocurrency is highly correlated with the stock market. Goods and services are more expensive than ever, and people are even starting to question the long-term safety of the bond market.
Really? US? I don't know about that. That's pretty fucking. I don't know about that. Silver? I guess. I haven't really looked into that too much myself.
People are quickly running out of safe platforms to stand on.
Do you still recommend Acorns? I do. I have a link that you get $20 when you sign up through mine. It's usually $5, so it's pretty good. It's like our least generous sign up offer, but it's still nice.
Which has got a few people saying that maybe these markets aren't actually broken. Maybe it's the money that's broken. So it's time to learn how money works, to find out if money actually works. This video is sponsored by Odoo. Odoo is an all-in-one business management platform that goes in and out of these markets, can have a big impact on the way that you live your life, even if you don't actually have that much in any one of these respective piles. Increasing housing prices have become a defining financial problem of young generations as people can't afford a place to start their own lives or their own families. House prices have outpaced inflation by a lot, which I know is not exactly shocking to most of you, especially if you have watched any of the dozens of videos we have made about the structural problems and broken incentives in the housing market.
Can't wait for the subprime crisis 2.0. There's a kind of some people think there's like a subprime car loan crisis potentially. It obviously wouldn't be as big, but people are a little nervous of that.
But the key here is that when we measure price increases relative to inflation, we are only measuring relative to the consumption pile here with the consumer price index. The problem with this is that it doesn't reflect the changing gaps between these other money piles. Real estate, for example, has grown faster than consumer prices, but relative to fixed assets like gold, it's actually gone backwards. An article published by Jonathan Hobbs, a chartered financial analyst, compiled this data to show that if you were paying for the average American house today in gold, you would be spending about half as much as you would have been back in 1991, and roughly a quarter of what you would have been paying in the early 2000s. Now, the article itself used this data to build a case for just buying gold. But
car loan delinquencies are rising, right? Yeah, they are.
The reality is basically any assets would have had the same effect. If you were paying in S&P 500 indexes, the relative fall in house prices would have been even greater. So there are two lessons from this. One is that investing
I guess if you're putting your money in the market, people fucking suck at saving in America, so.
is important. I hope you already knew that. But the deeper lesson here is that it's become much easier for people with lots of money in these piles to buy basically anything they want from these piles. There is only so much money that people can spend on consumption, so wealthy people naturally throw the rest into one of these. As they have grown, they've provided more money to people who own them, and since most of them were already maxing out what they could throw into consumption, they put even more back into these piles, creating a feedback loop of wealth generation. A basic look at the historic numbers makes this pretty clear. Market returns over the past 60 years have averaged just over 10%, and inflation has averaged just over 4%. If you include taxes, this generally means if you can consume less than 4% of your invested assets annually, you can live forever without touching your principal.
That's the goal, baby. That's the goal, baby. Who's doing the 4% rule out there in chat? I want to see ya.
This basic arithmetic is the foundation of things like the financial independence retire early movement. But
yeah, it's kind of dead though. People aren't doing FIRE as much anymore. People just got lonely.
For extremely wealthy people who can easily afford to live on less than 4% of their net worth, they can compound wealth faster than they can spend it. Now compare this to most people who earn their income by selling their time. Most wage increases are indexed to consumer prices if you are lucky, which has been the slowest growing one of these piles. This has made it harder and harder for the wages to compete when both groups want to put their money into the same area. A lot of what the wealthy are buying is
buying my house with Klarna. I wouldn't be surprised if we start seeing like down payments on fucking, a service like that.
Different from what working people are buying. But there are some areas where these cross over. Real estate is just the most obvious and socially destabilizing example of that. The reason this is happening now is that the growth in these asset piles has become unprecedented. We have been paying a lot of attention to what the money printer has done to consumer prices, but these other money piles have soaked up much of the excess cash, and it has put non-asset owners further behind.
Yeah, but you can get them with fractional shares and whatnot. So I mean, real estate, sure, that's difficult. I guess you can get into a REIT, but bonds and real estate, or bonds and the stock market in general, you can still get into.
Now, the point of this is not that inequality has become worse. You already knew that. But a new problem coming from that is how these increasingly consolidated markets are behaving. According to the Fed, participation in the stock market is approaching all-time highs, which sounds like a good thing.
Yeah, I mean, people know Social Security is not going to be great by the time we retire, so better get on investing.
But this has mainly been driven by lots of people investing very small amounts of money through platforms with low fees and low barriers to entry, like Robinhood. The real money in these asset markets is more consolidated than it has ever been, with the top 10% of households owning 93% of all equities the last time this data was collected at the end of 2024.
Yeah, and I could see that definitely making sense, especially with founders or initial equity holders within companies that go public and balloon like crazy. That's going to put that percentage substantially higher, right? I'm curious about those who have bought in. What's the percentage of those who have bought in and didn't like found something or was like an early contributor? For those who have bought in, what's the percentage of Americans who own 93%?
In a market panic, the reason why people sell their assets is because they want to make sure they have enough cash on hand to cover their most basic consumption needs if they lose their source of income, which for most people is their job. Unfortunately, job losses and market downturns often go hand in hand. However, as these assets have become more consolidated amongst people who can easily cover their living expenses several times over, there have consistently been more people with lots of spare cash to buy in versus the people that need to sell out to cover themselves in a hard
Well, I certainly hope the fuck they do, because listen, let me tell you, if the stock market just endlessly goes down, we're all fucked.
time. Put another way, if unemployment was to hypothetically spike tomorrow for any particular reason, most of the people losing their jobs would not have a meaningful pile of assets to sell to cover themselves while they were looking for a new job.
Yeah.
And it's not
You definitely have to have a 6-month emergency fund. I mean, that's as clear as day.
like we would miss the consumers either. A majority of the consumer spending in the economy now comes from the top 10% of households, and corporate profits are primarily driven by selling stuff to other corporations. Sounds pretty bad, right? Well, it gets worse. Remember those record-setting stock buybacks from earlier? Well, they have outnumbered net household share purchases 6-1, adding even more people to the side piling money in. If you add this to the rise of index funds that mindlessly buy and hold a broad selection of shares, it's easy to see how lopsided the market has become. Now, this does not mean that markets can't fall, but what it does mean is that they can stretch far further and stay irrational far longer than they could ever before, and while they do, they are throwing off money like never before for people to buy up every other asset market. Sounds pretty bad, right? Well, it gets worse. A huge amount of this money recently has been tied up in chasing returns from AI. These companies
Bubble. Is it a bubble? Is it gonna pop?
have spent trillions of dollars on this project so far. But watch this video next to find out how it's costing all of us just as much, if not more, and
That's pretty good. Listen, it is a bit weird that the market is at all-time highs with the weird economic data we have here. A lot of people think it's priced in rate cuts and whatnot. So maybe that's what it is. I don't know. Hey, Caleb Hammer stream fans, make sure you get your financial score for free. Take the assessment at calebhammer.com or dollarwise.com. It's free. See where you stand in the world of finances.